to FY25 constant currency revenue. But on that note, let me bring on board our next guest for today. Joining me is Rishi Kohli, CIO Hedge Fund Strategies at InCred Alternative Investments. Rishi, lovely chatting with you, and we are chatting after a long time. Just want to ask you your thoughts on what's happening globally. The world trade order is changing and how, and every day there's some comment from Trump which we tend to react to. But of course, now the reaction has been fairly, on the opposite side, so to say. We are raging on in terms of recovery. So what is your prognosis of the entire situation and how it has unfolded really?
Yeah, thanks for having me on the show. Lovely to be back here. Yes, so obviously very different world from a few months back when we spoke, I think. And of course, Trump, we've seen this in the past also, that he has this habit of, making large comments, over the weekend sometimes, on important days, etc. So obviously a lot more volatility compared to, typical presidents where the volatility is muted. So the volatility, I think, will remain higher for the next couple of years as long as Trump is around. That is very clear, and we've seen, the initial parts of that over the last month. But yeah, coming back to overall markets, I think, very early days and very confusing signals. Obviously, he has this habit of, giving these larger numbers and then bringing people to the negotiating table. And he's himself commenting now that the tariffs, even on China, may be much lower, than whatever has been said recently. So I think it'll all settle down, to much more normal levels than what initially it seemed like. Having said that, it is very clear that there's a global shift, against using the US dollar. China's built its own digital currency network. So all these shifts have been gradually happening over the last few years. And I think, these kind of episodes will only sort of accelerate that. So from a very long-term perspective, I would say very clearly the dominance of the US and overall the strength of the US dollar and it being there as a reserve currency. I think you've got the initial signals of, that starting to decline. And I think that will continue for many years now. And coming to markets, of course, a lot of markets.
Sure.
Yeah, a lot of markets were, I think, overextended. Yeah, thanks. So a lot of markets were overextended, I think. So, there was a jerk, of course, in that few days and, 1 week of that initial tariff announcements. And the recovery over the last week or so, especially in India, has been very surprising to most of us, most of the market participants. Having said that, more from a technical and a cycle perspective, if you see, since I focus more on quant, it is actually very interesting because, all the markets, whether it's US, India, they've all just corrected to the long-term supports and previous breakout points or previous channel supports, and then bounced strongly from there. And in fact, the lows of that week or the few days around the tariff announcements are the lows of the month. So far, actually, apart from the panic that was created, and of course the fact that, last few months, all markets globally were declining anyway, and again, especially India. So, it was sort of a continuation of that, and in a jerk, it sort of stopped. So on the balance, that seems bullish behavior.
Sure.
But of course, a lot of confusion, fundamental, macro, technicals, to come to a very clear conclusion.
Sure, but despite the fact that we've seen, US market, of course, staged a rebound last night, but, all of last week, if you see, US markets were down, even Asian markets were down, global markets per se were down, but we were outperforming. So given the pace of the recovery, would you be surprised or not surprised if, we hit or retest, all-time highs, say by June or so?
Yeah, I wouldn't be surprised. As I just said, that on balance, at least from the data side, on balance, the structure looks bullish still. It has not got affected. And we had this sort of slow decline since the September peaks. And of course, October, Jan, Feb, these were panicky months with all small mid caps, everything declining. Now, obviously, April has some seasonality. So usually April ends up, being bullish and taking all negative news in its stride. May is usually the dangerous month where a lot of volatility comes in. And if this is a dead cat bounce. You should start seeing declines again. But if that doesn't happen, then I think yes, you could head back to new highs. I think for Nifty index, there'll be a significant hurdle around 25,000. If that gets crossed, then 26,000 may just again come in a few days. But given the fast pace over the last week, I think it may halt around 25,000 for some time, and then you'll get further signals from there. The good thing for India is that the financial services and the banking index, etc., are already at new highs, right? And even in the decline, if you look at the financial services index, the Fin Nifty, right? So that hardly declined, right? I mean, even when Nifty was down at the bottom around 18%, Fin Nifty was down only like 6-7%. There was hardly any decline. So it was one of the strongest sectors, and it bounced back to new highs very fast. So that at least shows you that parts of the market are at least clearly bullish. So even if overall markets go into some sort of a time correction, you would definitely have sectors which are doing really well. So I think from that angle, there's a lot to look forward to.
Sure. So which are those sectors, Rishi? If you would like to elaborate, what should the India playbook look like right now? The investment playbook, banks, financial services you mentioned, but what about the other sectors? Which are the ones that one should look at in the current environment?
Yeah, sure. So bank, financial services, I mentioned more the technical and the cycle perspective. Obviously, RBI has been doing a lot over the last few weeks. So, the fundamental macro ties in as well. So not surprising, if all sort of signals coincide, then I've seen that, those end up being the best signals for the medium term at least. Otherwise, of course, from an overall sector perspective, the currency, so INR looks like, it could be stable to appreciating after a long time, right? Where obviously it has been a continuous depreciation for a very long time. And they've been step jumps typically, and we've all got used to it, including me. But recent action says that, even if it doesn't appreciate very fast, it'll at least be stable and minorly appreciating for the next 1 or 2 years. So obviously, if that happens, then, obviously not immediate impact is on IT pharma, maybe not that great for them. IT has been one of the worst, sectors in the last few months. Right now, it's more of an oversold kind of sector. So, today it's very strong, for example. So I wouldn't be surprised if over the next month or so, it does well. But from a medium-term perspective, I wouldn't be very bullish on that. The sectors which are looking interesting are, again, not very surprising, more, domestic related. So infra is looking good, auto is looking good, PSE index is looking good. Having said that, I mean, from my perspective, it's more short to medium term, not necessarily very long term. So from 1 month to 6 month kind of views, I think these are the sectors which look good apart from financials.
Okay, let's talk about the other pocket or other asset class rather that's been grabbing headlines on a daily basis, which is gold. No surprises there, $3,500 an ounce has been crossed. What's your view then? How is gold looking as a portfolio hedge now to you?
See, from an asset allocation perspective, obviously still looks good. And we've, in recent times, we've all seen the data, whether it's 5 years, 10 years, 20 years, 50 years, having certain allocation to that has obviously helped. And in different patches when, equities and bonds have not given returns, gold has. So from that perspective, I think it should continuously be there up to a certain percentage for all portfolios. Right now, from an immediate perspective, obviously, given the panic globally related to overall markets coming down and then with the tariff tantrum, etc., obviously, it has had a big spike over the last month, right? That obviously in a short term looks unsustainable. So, you could see some declines, etc. But I wouldn't, there've been some rumors and talks in the market that it'll have a big crash, etc. So I don't agree with that. I think, obviously it has got overextended. There's almost been a vertical rise over the last 1 month and over the last 6 months. So obviously that vertical rise is usually, unsustainable and will have some short-term corrections. So I wouldn't rule out a 5-10% correction in the near term, but from a long-term perspective, it still looks good.
Okay, any targets, if you talk about 1 year, 2 year, any targets on gold? 3,800, 900, 4,000 even for that matter?
It's possible. Yeah, it's highly possible.
Sure. So, what is that percentage of in fact, what kind of allocation should one make in their portfolio when it comes to gold? Of course, buy on dips. That's the strategy you mentioned, right? So, how much of an exposure should one really look at the current juncture?
Again, it'll vary based on, everyone's sort of risk reward perspective and overall objectives on the returns one is trying to get. But I think, at least 10% is a fair number. And then, yeah, it'll vary. It could go higher depending on what kind of portfolios one is constructing.
Is there a thumb rule now to look at, some alpha generation ideas in such volatile times? Any strategy, any particular strategy that you would recommend for our viewers?
Yeah, so as I said, sector rotation will continue, and that is actually a good signal because, as per our long-term quant research, and I may have mentioned this in the past shows as well, that as long as there is healthy sector rotation happening and there are some sectors which are doing well, that's a sign of bull markets actually, irrespective of, whatever declines may be happening in the short term. So I think that will continue. So, having some interesting models, whether technical or based on fundamentals, to sort of tilt weightages towards certain sectors and be a little more tactical on that, I think will make a lot of sense. Even on markets overall, I think being tactical for this year will make sense because it may not, even if the recovery happens, it may not be one-sided. You may get 1 or 2 months of strong bounce and then again it may go sideways. So it will not be as easy as, say, the last 2 years before from September, the market started declining for us in India. Before that, 2-3 years were very, very easy. Whatever portfolios you had did well. So I think it will not be that. There will be a lot of differentiation. So one will have to be much more tactical and short term. And of course, if you come to very short term, then, playing it through futures and options. So like, we run market neutral strategies, for example. So I think there will be a lot of that kind of alpha in the markets because there is already a lot of dispersion that has happened across stocks and sectors, right? Even within sectors that are doing well or doing poorly, the stock scenario is very, very different. So that lends itself very well to having, market neutral or long short strategies, where even if you're long some stocks of one sector and short some stocks of the same sector, you can have alpha. So I think it is a good time over the next 6 months to 1 year for these kind of strategies, because while having lower exposures to market, you can still generate market-like returns, equity-like returns.
Sure. If you talk about this year, I think it's too early to ask, but still, what would be a fair expectation in terms of returns on the index for this year? A lot of experts have been pointing out that the era of easy money may be behind us, low single-digit kind of returns. In your prognosis, what would be a fair return expectations for the year?
Yeah, so for this year, as I said, I think it's going to be a little difficult, both for investing and trading. It's not going to be easy, but you have to be tactical and a little, short to medium term, meaning in my world, it becomes more like 1 to 4 months kind of views rather than having 1 to 3 year long-term views. So not really buy and hold to that extent, whether you look, even if you look at fundamentals, etc. So from a very top level index, Nifty level, I wouldn't expect, if it goes back to the previous highs, I'm sure it'll even then sort of consolidate there for some time and not just blast through that. So on the index level, I would say, to keep expectations low, only 8, 10, 12% at max. But yeah, as I said, underlying sectors and stocks, there will still be a lot of further alpha to be made if one can be tactical and capitalize on those opportunities.
Fair point. Last question really, what's your take on the dollar index? From 110, it came down to sub 98 levels. Of course, it's at 98.5 now. And FIIs have also made a comeback, so to say, in the Indian market. But within the emerging market basket, would you say that India looks prime for FII flows, and the trend that we have seen recently is here to stay because the treasury yields in US are elevated, dollar index is falling. So in that scenario, can we say that FIIs are here to stay for a bit at least, if not the very long term? In fact, if not the medium term, so to say.
Right. Yes, I think so. And again, FI flows are a bit correlated to overall momentum in the market and sentiment in the market. So, we keep dissecting that data in different ways and give it a lot of importance. But again, it is important in the near term, but in the medium to long term, it really tracks the momentum if you correlate it. So given that, momentum has been again improving recently, combined with the fact that obviously all the fundamental and macro arguments for India, we all know, you're right, better growth than any other market in the world, stable, currency, stable government, etc., etc. So given that, I think it is one of the few spots, enough people have said that. I would agree with that view largely. There will be volatility here and there, but yeah, relatively, I think the whole world is coming to the conclusion that it's a better market. And even the depth of the market has increased over the last few years, which is very good because, say, 10 years back, we didn't have the depth and breadth of stocks of above certain market caps, but now we do have. So that's another thing which, large institutions and pensions and all like. So even that is ticking the right boxes now, which was not there 5, 10 years back. So all of this combined, I think, yes, I mean, on the balance, they would continue, but, they would still be susceptible to some global events and what the US is doing, etc., from time to time. So I think short term, you'll need to ignore, but medium to long term, I think that will help.
Sure. Another question then. Do you think the US will be able to avert a recession, or do you think the damage has already been done to the economy? There are a lot of conflicting views on this, right? So, what are your thoughts on whether a US is really headed for a recession?
Yeah, so I think it is, but the pace may be a bit slower than what people are thinking. So in my opinion, as I said at the start of the show, that I clearly, their heydays are over, both from a market, economy, and currency perspective. But having said that, it is the biggest economy in the world. So, the larger the entity and the faster the entity has been, obviously it takes more time to sort of really go downhill completely. So I think the next 1 or 2 years, it will be like a slow decline, and post that, the recession may speed up there. So the first 1 or 2 years may be confusing, there'll be conflicting signals and the recession will slowly start, and then it will sort of get full blown, in my opinion. Which is good because, globally, if there was a shock to the US, then I think everything globally would get affected. But if it plays out in this manner I described, then the world will sort of adjust itself better. And therefore, you will avert panics globally. So I think that would be good for the overall markets everywhere globally.
Sure, point taken, Rishi. With that, I would like to thank you for taking out time and joining us this morning. Always a pleasure. Look forward to more conversations in the future as well.
Thank you. Bye.
Thank you. Lovely chatting. Well, on that note, quickly take a look at what the market is doing. Bank Nifty has slipped into the red. In fact, some bit of profit taking kicking in after 2 straight days of the index hitting record levels. But rest of the market is looking fairly strong. Nifty is around that 24,320 mark. Mid cap index now moving in tandem with the benchmarks. Sensex as well, clutching on to that 80,100 mark. But important news: Ather Energy has filed for its red herring prospectus with the SEBI. This IPO includes fresh issue of up to 2,626 crore rupees. The IPO includes OFS of 1.1 crore equity shares. Founder Tarun Mehta and co-founder Swapnil Jain will be selling 19.6 lakh shares. The roadshows have begun in Mumbai today, and the anchor book will be opening on the 25th of April. The IPO opens for subscription on 28th and closes on 30th. It will be the first large main board IPO of FY26, and in terms of pricing, they have set the IPO price band at 304 to 321 per share. So yes, first big ticket IPO of FY20, main board IPO of FY26, Ather Energy. Watch out for that. And of course, but that's about it then. We've come to the end of this show with that. Of course, strong momentum. Nifty above 24,320 and rest of the market also looking fairly strong. With that, completely timed out on this edition of Opening Bell. Thanks a lot for tuning in. Have a good day and stay tuned to Money Control for all your other news and updates.